usual time. And I hope that you find time to listen to us. If not, you have a place to go and you don't need to worry. We always save all of our webinars on YouTube channel. We have a library with over 1,000 videos. You literally can search on that. Let's go to take a look. And here is our website, communitycpa.com. And our client comes here very often. They go to client portal and they pay invoices here for us. And we appreciate every single client we have. We have over 10,000 clients, and all of you are making us here and giving us luxury to work, and we appreciate you. And on our website, you can go to appointment, and this is where you can see the partners, and you can select any one of us and book our time. Dr. Howe specialized in ERC and R&D credit, governmental programs, buy and sell, company formation and dissolution, and you can book his time by knowing what time is available. It's just really convenient. There is a fee in here, however, and we have never ever had anybody who would come around and say, oh, I didn't get anything with the meeting and your fee, you shouldn't charge our fee. Never ever. And it is always a praise from our client, knowing that how knowledgeable we are. And we also have this knowledge bank for you called the Community CPA YouTube channel. You can literally search for anything you wanted. Today's topic is income deferral. So let's get on to our income deferral topic, and you will see this webinar right there on the screen. And once you can find them here, then you can watch it at any time. All of our webinars, we have a PowerPoint to go with it, just in case my Chinglish didn't fit you, you felt like you need to look at the words, there you go, right? And also, the way we talk here allow you to not watch the slides. You don't have to look at anything. You can drive and you can put in your earbud, and so you can listen. So all of these things just made it easier for you to learn, because if you are like me in business, you really do have to learn, and business do grow and the concept changes. So we want to make sure that you want to grow your business with the knowledge you have from here. We actually have CPAs from other CPA firms later on would email me and tell me that, hey, I'm actually learning from your webinars. So we're pretty proud of what we can offer you here. All right, tax strategies utilizing income deferral. So income deferral means what? Income deferral, it just reference to a practice of delaying the receipt of income to the future date, often for tax purposes. And this is commonly seen in the retirement account and the certain compensation plan, right? Where the individual can delay receiving income, potentially reduce their taxable income. So income deferral is a strategy to pay less taxes for the year we're talking about, for example, 2023, right? So you're not late yet, and we're going to give you the tool right now. All right. Before we start webinars, and we always have new people join us, right? So I want to introduce myself to you. And my name is Ying. I am the CEO and the managing partner for Community CPA. Community CPA has 26 years history on the market, and we have teams speaking 10 different languages. Okay, that just give you a feel of, out of the 40 people, we speak 10 different languages. So what kind of mix we have in diversity, right? And we are purposefully in our 26 years running and paid attention to people who speak second language but yet have the accounting tax knowledge. And so that way we grow this team, because our goal is to make sure that we touch on every corner of the society, providing them with the top-notch knowledge that you otherwise would not get, right? And I served on National Taxpayer Advocates Panel, a federal advisory committee to IRS for 3 years. And I wrote this book called Appointment with Ying at 8 a.m. Yes, it is 8 a.m. because that's where you start up a business. That's why it's called 8 a.m. And I also published this year the second book called Appointment with Ying at 10 a.m. Yes, 10 a.m. and it is 2 hours after 8 and you grow your business. So we plan to have 4 books published in the series of Appointment with Ying. Appointment with Ying at 2 p.m. and 6 p.m., which will be expanding your business. 6 p.m. will be retiring from your business. So that is our 4 books, and I'm working on the 3rd one. No responsibility disclaimer, no brainer. This is a free webinar, and you will be diligent for what you learn and do research on your own. And if you like our knowledge, believe we can help you, and want to be more specifically for your situation, you can go online, book our time, and engage us for a consultation service, or you can simply come into one of our branches and to engage us in person and let us help you to file taxes, do tax planning, do your payroll, do your accounting, and do your legal work. And we do have attorneys in our firm. So with all of that, and I think we're one-stop shop for you if you believe we can help you. Income deferral in general, income deferrals equals to pay tax later. Do not equals to not pay taxes. You're gonna pay taxes later, just not right now. Why is people caring about income deferral then if I have to pay taxes later anyway? Of course, there's a lot of reason for that, because to defer to later, and then maybe later you don't make so much income anymore, so it's beneficial to pay later, right? And maybe later, and you are going to some other places, their state income taxes doesn't exist. That's later, right? Or maybe later, just because that you do not have money to pay so much taxes right now. If income is a one-time windfall, you know what I mean. It's just gonna be racking up taxes so badly, and you just like, oh, I'm just gonna make this $1 million this year one time. I will never have another chance to make this 1 million, and you make me pay what? $370,000 taxes? That's too much, right? So that's the situation. If income is a constant stream, then income deferral need to be a long-term and a repetitive organization. You need to figure out how to do that repetitively. What is the difference between advice from your tax planner like myself and your financial advisor? And I always say that we are completely different animals on the planet. And your tax planner and your financial advisor are not necessarily projecting the same thing. Financial advisor advise you about the future. You put in $1 with me, it may become $1 million tomorrow or 20 years down the road, right? You hear that. The calculation of the future, though, is based on the assumptions. Assume we're gonna make 8% of interest. That's just not true in the past 15 years, right? But a lot of policies are based on assumptions. And these assumptions are limited to what? To the experiences of today and the past. Because the future projection, you really don't know. For example, I want to give you an example in terms of, for example, Iowa. Iowa is a state we tax income tax. But our governor, Kim Reynolds, right now is working on making the state not income taxable. Income are not paying taxes. And you imagine if she get that through, and then the projection you make on the Iowa taxes is just totally wrong to the future. So the future is really unpredictable, especially with technology being this way. And we felt like in the daily life, right? Things are updating much faster. Even house renovation become a lot more frequent, then a house can stay on being used for 100 years, but this last 50 years had 2 renovations already going on. So with that said, everything is just updating, changing, and meeting the needs as we speak. So taxes is not gonna be the same. So saying that, okay, we're gonna save taxes, you pay taxes today, and the future you're gonna pay more because you're gonna make more, and that assumption is really kind of childish to me, okay? The tax planner like myself do not make assumptions. We don't assume 5 years. I don't even assume 2024 because there is a presidential election. Right now, we are just focused on 2023, and we are just saving your tax for 2023. And we can limitedly talk about 2024, but the reality is the rule changes, and you want to focus on present. Like Eckhart Tolle wrote the book, right? The Power of Present, Power of Today, the power of planning just what you have this year. That is tax planner. And if the word is always like, if you can save $5 taxes today, but someone promised you to pay the taxes $5 because you're gonna have $50 more 20 years later. Do I care? No, I'm going to watch the $5 saving I have today. So with that philosophy, we're going to go in to talk about income deferrals. So, anything that promises to reduce taxes today, it is thumbs up. Anything that promised me the future, like Roth IRA, backdoor Roth IRA, and that is a no, as long as you are paying taxes. We have a lot of clients come around, high income clients, come around, ask me about, okay, should I do a backdoor IRA, a Roth IRA? So my question is that do you have any other ways to defer income? Because that's not an income deferral. That is actually have you pay more taxes today, so hoping that your revenue, your income is going to be generated so fast that overriding your taxes you pay today. Not a good deal. So let's go on to talk about tools that we have to defer income, therefore defer taxes, therefore pay less taxes in 2023. So most common ways of deferring income as a small business owner, right? I'm talking to small business owners. And so these are common ways. Let's go down the list. To deposit your December income in January if you are on cash-based accounting. You know what I mean. We're in December. If you're getting a check that paid to you for you're going to deposit as your income, then if you're on cash-based accounting, deposit them in January. To identify what is your unearned revenue, I actually talked about this one with someone this morning because they're in the business that people pay ahead of time. So in December, some of the customer already paid for the whole year of 2024. That is not your income. That is your unearned, is actually your debt. If you do not perform for 2024, you actually have to refund the money, don't you? Unless in your book, it says that once you give me, even though I don't perform, and you still cannot get the money back. Of course, if you have that in your contract, you should recognize that as a revenue. Otherwise, it is not earned. It is liability. To make certain down payment for your project, but the project is not yet started, is not income. So you don't want to deposit, you don't want to count your customer deposit as a down payment to your income because you haven't even started the project yet. In accrual-based accounting, to identify bad debt allowance based on your operating experiences. So accrual accounting means that you got your income there, but you also have a bunch of receivables. But if your receivable write-down rate is 50%, then you need to reduce your income by that 50%, which we call them bad debt allowance, right? So that is something that you need to really look into as a business owner. Of course, delay your Social Security benefit. You can delay it. You can delay it to 70 to start drawing it, which will defer your income so you pay less taxes, because if you had so much money around, your Social Security will be taxable, right? Majority of it will be taxable. Put money in the employer-sponsored retirement plan. That is a way to defer your income. So if you work in the company, or if you have your own, like small business owners, you set up your own company, and then you can set up these retirement plans so you can put money in there, and that would put it away for you. And that money you put in the retirement plan, you can deduct it so that you don't pay taxes. So fund HSA account, that's the health saving account. And this one I listed here, I did not go down in the details for you, because that is something that by itself can be a subject. But you know that if you put money in the health saving account, that is not taxable. So you can reduce that and stay away from income tax. Deferred compensation plan. This is like the pension plan done by the employer. We will go into that. All right, so today I'm going to focus on the following things. They're a long list, but don't worry, it's not so complicated. Traditional IRA, Roth IRA, SEP IRA, and simple IRA, solo 401k, profit sharing plan, and defined benefit plan. So let's go. So income deferral, traditional IRA. We know that, right? We know that so well. And you know, whether you're a business owner or not, you can go to buy IRA, and there is an income limitation, but you can buy it and deduct your taxes. Commonly, we see that folks purchase the traditional IRA, so their income tax will drop. So that is a defer, right? That is an income deferral on traditional IRA, and it's not limited to business owners, but anybody can purchase that. And there's a couple limitations I know, like income limitations, and also you need to stay within the $66,000 range. So if you already have 401k plan at your employer and you cannot do the traditional IRA, so those are the things will come into play when you buy it. When you buy it, your financial advisor would give you the rules around it and to make sure that you are eligible. But this is one that if small business owners runs a pretty successful business, traditional IRA is not your way to go. Roth IRA, no tax saving today. Roth IRA is an IRA that you put in to this Roth IRA account, and you don't get tax saving today, and because you have to pay taxes on that. When we say taxes here, folks, remember, we're talking about income tax, right? We're not talking about payroll taxes. We're not talking about sales taxes, property tax. No. We're just talking about income tax. The one that you file 1040 and then make you cringe because you pay a lot of money to the IRS. So that tax saving for Roth IRA is not there. So if someone come around to me and is saying that I'm eligible for traditional IRA, I'm also eligible for Roth IRA, should I do traditional or Roth? Without thinking, I don't need my brain, my answer will be traditional IRA, because you are paying taxes. Unless you don't pay taxes, then if you don't pay taxes, it means your income is low. And where did you get money to do Roth IRA? It just doesn't even make any sense. As long as you pay taxes, Roth IRA is not a way to go for me. And as a tax planner, I would not recommend that. So backdoor IRA, no tax saving today. Again, so this is a strategy for high income individual. They can use the contribution to a Roth IRA even if their income exceed the regular contribution limit. So you make a lot of money, you want to do backdoor IRA because your income threshold already over, so you normally cannot do a proper ordinary Roth IRA. So what's so-called backdoor is not going to just directly purchase. You actually will be buying traditional IRA, but you don't get the tax deduction, non-deductible contribution to a traditional IRA. What does that mean? It means you put money in the account, you already pay taxes for it, but when it come out, you're going to continue paying the taxes. That's a traditional IRA. But what happened on the backdoor process is that you put in the traditional IRA, then you immediately convert that to Roth IRA. Okay? Consideration is, of course, there is a tax implications for you, and you need to pay taxes on it, right? And just Roth IRA just says that anything grows in there, and you are not going to pay taxes. So you're going to come out with your distribution of Roth IRA when you retire. It's a check to you. You don't have to worry about taxes. So that's kind of the result to invest in Roth IRA. Taxes on conversion are calculated based on any earnings in the traditional IRA are reported in the year of the conversion. If the conversion is done properly after the contribution, there may be a minimal or no earning and minimizing the tax impact. So they're saying that if you do the conversion at the same time where you're contributing, it can be maximizing the tax impact. But this is not to say that you don't pay income tax at all. You are paying income tax on the amount anyway. So that it's just getting away from the limitation of Roth IRA. So you can contribute to Roth IRA even though you're over the limit. So that's what that backdoor IRA is all about. And overcoming income limitation for Roth IRA contribution, that's the benefit. Potential for tax-free growth and the withdrawal. And yeah, that is the promise. The tax-free growth inside of the Roth IRA when you withdraw, if you withdraw after your retirement, it will be tax-free, right? So diversification of retirement income tax treatment. Of course, diversification is just, you don't have to just have one retirement account. You can have multiple. So backdoor IRA, Roth IRA is one more tools you have. By utilizing the backdoor IRA, Roth IRA strategy, high-income individual can still take advantage of tax-free growth and tax-free withdrawal in the retirement of Roth IRA offer, right? So that is where, I can put your minds at ease, knowing that the traditional IRA helps you to save tax today, Roth IRA not, backdoor IRA not, okay? The next one we want to explore is SEP IRA, 100% employer's money. What does that mean? That means that if you have a business, for example, if you have a business called Community CPA, and then what you do is you are the owner, so you are going to put in money for your employees. So let's look at this. It says SEP stands for Simplified Employee Pension. Okay, let me get some water. Actually, it's tea. I made some tea. I normally like to drink coffee in the morning. In the afternoon is a tea time. What a culture, right? A lot of folks in our firm is like that. Morning coffee, afternoon tea. If we regularly work in the evening, that will be liquor and the wine. So celebrate, right? All right, let's get back to our things here. So this SEP IRA plan and allows employers, which is you, the business owner, to make contributions to traditional IRA set up for your employees. You see, this is you put money out for your employees. And it is only employer's money, which means that on your income statement, you'll have a line called a SEP IRA plan. So whatever you put into the employee's account, it will come up as a expense entry, like utilities, like any other expense. You can deduct it. So what it says that there is a maximum. It's easy to set up and do have a contribution limit. So maximum 66,000 in 2023. So that 66,000 is for each employee. All right. So how did they calculate that 66? Is generally speaking is 25% of eligible employees' compensation or less. If that employee makes $100,000, then your 25% that is 25,000, right? So if I give you example here. If you put away 66 for 3 employees, then your profit will reduce by 198,000, and you will save in average about 60K in taxes, 60,000 in taxes. And this is every year, right? That limit changes every year. So just remember, SEP IRA plan is 100% business owner's deduction of their business. And the maximum, we have this maximum number on here, and you know that you will reduce your income tax. So this is what we call income deferral, right? Because that money did not get spent. It just went to another account. And in there, you can invest, do whatever you want, right? But it is your money and under employee's account. Simple IRA, employee and employer can both put in the plan. So this is the first one we talked about, SEP IRA, is just employer, right? But this one is both employee and employer can put in there. Simple IRA is also called Saving Incentive Match Plan for employees. The plan allows both employer and employee to contribute to traditional IRA, only for business with fewer than 100 employees. Keep that in mind. If you're too big, you cannot do. But if you're only 1 employee, you can still do. Employee salary reduction contribution is $15,500 in 2023. If you're over 50 years old, it's $19,000. What is employee salary reduction contribution? This is what we call the self-deferral. So a good example I want to give you is that, let's say if you make $30,500 gross salary, and you're the employee. You normally get a W-2 with $30,500 on the box 1 W-2. But if you can defer your income and down to $15,000, because you can contribute and you can do the $15,500 contribution. Okay, that is employee salary reduction contribution. So put the part of income, the $15,500 income, outside of your taxable income, and it went to your simple IRA account. Okay, so employee has the discretionary to do it, because I got paid. As long as I got paid for more than $15,500, I can put it all into my retirement. But for employers, and for this plan, there is a requirement of either or, so you do one of them. One of them is that the employer will match 2% of the gross pay. So if you're making $30,000, then the employer will match 2%. So that would be $6,000, right? So that would be something you do on the 2%. It is non-elective contribution, just means required. You can't. There's no choice. You're gonna do 2%, or you do dollar for dollar match contribution up to 3% of the compensation. So these are the things that the employer has a requirement to do. So when employer are required to do contribution, they don't have a choice, they have to. If the business is not doing good, you want to save from that, no, you can't, because you have a simple IRA plan, right? So, but these dollars you contributed to the employee's account become a deduction for you. So you can deduct that away from your profit. See, that is a deferral, right? Income deferral by doing the retirement plan this way, using simple IRA as a tool. The next one is called solo 401k. The owner can double dip the plan. So solo 401k, as the name suggests, is kind of like just yourself. Solo 401k is also called individual 401k. It is designed for self-employed individual and business owners with no employees except your spouse. Okay? So two of you. You can do two of you. The plan allows owner employee, you, to put in contribution, and also allows the company to put in contribution. That's why it's a double dip. So for example, if I have a company myself, and I pay myself $100,000 on salary, and I can do a solo 401k for myself, okay? For 2023, I can contribute $22,500 if I'm under 50. If I'm over 50, I can contribute $30,000. What does that mean? That means my $100,000 W-2, I just need to pay taxes for what? For $77,500, because $22,500 got deducted, or just for $70,000 because it's got deducted, right? And so with that, you pay less taxes, didn't you? Because the W-2, you got reduced amount. So that is the self-deferral piece, the piece that reduces your salary. For 2023, the company can contribute 25% of the owner's gross wages. 25% of the owners of that person's gross wage. So for example, if you were running for $100,000 payroll, gross pay, so 25% is $25,000, right? So you can add $25,000 to the $22,500 you have, then that's become your total put away, which you don't pay income tax. So the combined total between employee and employer contribution for 2023 cannot be over $26,000 if under 50 years old, cannot be over $73,500 if you are over 50 years old. So there is kind of overarching threshold. So I have an example here. John makes $174K salary. So he has a W-2 for $151,500 in his hand. So when he fill up his 1040, he's not putting in 174K, he's putting in 151,500. And his company, his own company, can deduct his payroll 174K plus 43,500. Where is that 43,500 come from? That's 25% of his gross pay. So he can walk away 22,500 plus 43,500, total of 66,000 tax-free income. Of course not in his pocket, but in his solo 401k plan. Save John $19,800 income tax in 1 year. So, with that said, you can see how that would work for you, right? And it is not late to set up solo 401k. And if you couldn't find anybody to set up solo 401k for you, we have a lot of clients who are financial planners, and we'll send you to them. And they can set that up for you. And the financial planner, will get $66,000 from you to invest. They're happy. And you don't have to pay income tax on $66,000. And if your profit is $66,000, I think our problem is resolved. and you don't need to pay taxes because you have a zero profit. It's already deducted, right? Solo 401k. What about the regular 401k? The regular 401k are also called traditional 401k. Is also can double dip, like the employee can double dip, not just the solo, not just the owner. So it is common for small and the medium-sized companies and for allowing the employee to put in their deferrals and also company matches. All right. So for 2023, and if you are over, if you are under 50, that threshold 22,500, same thing like solo 401k. If you're over 50, you got $30,000 you can put away. And then most of the companies are doing matches, right? You know, a lot of times, you know, you realize that, oh, my company do 401k, they match 3%. That means if I put away 3% of my compensation, company give me a 3% match. So if I put $600 away, they give me $600. But why should you just put us 3% on your own? Do 22,500. Do the maximum, and your company is still gonna match you with that 600. But some of the companies do bigger match, and I mean, typically most of the companies would have a percentage for you to match. And at our company, we don't do match. We just say forget about match, and we're gonna give you 3% anyway. You do it or not, we just give you that amount. So there's also company doing that. The reason some of the company don't do match because some of their, most of their folks are very young. When the employees are very young, they don't care about retirement. They don't even want to know how to spell the word of retirement because it's so far away, they don't see it, and they think 3% is nothing, and they just don't have the mind to save. If the employer come around like our firm, we just put that away for you. So you match it or not, it doesn't matter. It's in the account, in your account. So that kind of forces that saving to go in. So become additional compensation, but yet people don't need to pay taxes on it yet because it is deferred out, right? So that is where I want to, make sure you understand on your W-2, you can defer as much as you want, up to 22,500, or if you're older, 30,000. So the government give you this rate every year. So just know what is the maximum and do the maximum. So you pay less income tax. And if you also, the business owner, make a match, the match, whatever match you put in, it is your business expense, reduces your taxes anyway for you, right? The overarching rule will apply the combined total between the employee and the employer contribution. It is 66,000, that magic number we were talking about. If you're over 50, it's 73,500. So always remember this, like kind of the top limit. But underneath it, you can be flexible. All right, so folks heard about 401k profit sharing. So profit sharing is also an income deferral tool, folks. So what is profit sharing? Profit sharing plan is 100% to employee, but it's 100% on employer. What that means is you're responsible. If you're a small business owner, that profit sharing plan, you're responsible. Profit sharing is a type of employer contribution, the business owner's contribution to a 401k plan that is based on percentage of company's profit. So if the company made profit, then you have a profit sharing plan going forward. Profit sharing contribution are not count towards to that limitation, the 22,500, 30,000. Remember, that is for each employee. You can do more. That is not limited to that. Profit sharing is also an income deferral, so put away to the future. Profit sharing contribution from employer is subject to the overall limit. Remember that overarching 66,000, 73,500. So it is there as well, but it's not limited to the personal, the 22,500 and the 30,000. There's a different type of 401k profit sharing plan out there on the market. When you work with your financial advisor and when you are ready to set up a profit sharing plan, and this plan will come out to you, and based on your specific situation will be whichever one is the best will come out. So the one that I have seen our client using most is the integrated plan and the age-weighted plan. So all of these things is a way to calculate when you how much to give to each employee. So age-weighted, just like what the word suggests, is by the age of the employee. You are older, and then you allocate it relatively more. If everybody making the same salary, that means you're older, you get more. You're younger, you get less. Right? So there's a career, right, called actuarial scientist, and these people are the one doing this. Please don't expect me to know all of that. I do not. I just know that profit sharing, it is for the employee, but 100% responsibility for the employer. So you can implement that. Whatever you implement, remember I said, it is reduce your profit, so therefore reduce your income tax. Defined benefit plan. It is a company-owned plan, just like profit sharing plan, and a defined benefit plan is also called a pension plan. Okay, so if you work for federal government and they give you a pension plan, and if you work for very, very small business, they don't know what is pension plan. If you work with medium size of company, a lot of them has a pension plan. It is a type of employer sponsored retirement plan that promises to pay a certain amount of retirement money to the employee based on a formula. The formula usually taking into account of the employee's age, salary, years of service with the company. Complicated formula, okay? I have never ever asked my actuarial scientist who calculated hours, saying, how did you calculate that? I don't have time for that, but it is based on the employee's age, salary, years service to the company. And the employer is responsible for funding the plan, managing the investment. And I mean, every year, the plan administrator would come to calculate, because they know that when people retires, so they need to calculate how much money you need to put in to sustain the plan. If some people retire and you can still have it, right? Then you heard of the Detroit. City of Detroit, and their pension plan went bankruptcy because what they put in couldn't sustain of the retirement needs of the city. So that's kind of what going on, and it is very possible. It is possible for employer to completely failed on these kind of investment. So that's why unrun situation happens and things happens, right? And I think the most important thing is that these plans are not come out of the employee's pocket. It is the company deduction. So if you put $500,000 in the defined benefit plan, you reduce your profit by $500,000, and yes, the money went to the plan allocated to the needs of the employee. But if your plan went belly up, what does that mean? That just means that the employee not going to have the benefit they thought they're going to have, right? But it is lost on the company. So example, if the company put in $500K in cash balance plan, it's a type of pension plan, and you can deduct this amount from your profit and pay less income tax. So that is about $150,000 tax saving for putting the defined benefit plan away. sometimes business owners want to know that, okay, if I have this cash balance plan, how do I know that it will be okay? I'm able to sustain the plan. Nobody knows, and you don't know. But if your business is so stable, and you're not thinking of getting out of the business anytime soon, it's always great to put that tax income deferral in, so you don't have to pay income tax. But here you got the money in there. What happens like if you just could not afford it and your business is not well, but the defined benefit plan has things in there, right? So if that's the case, when you couldn't carry on with these pension plan, it actually can be dissolved, and the money in there will be distributed out to the participants, to your employee. So it's not a total loss, but it's really a great way for successful business to deduct your income, and so that way to reduce your profit so you can pay less income tax. All right, we ran very fast with all of these informations I gave you, and all of them is just simply the tools to help you to know how to pay less income tax this year by deferring what? By deferring your income. And deferring your income, you remember the earlier slide we have, and the deferring income are things you can do if you are cash method accounting or you are accrue method accounting, and if you have unearned revenue, and all of these things are business regular and you do it. But at the same time, knowing that these deferred benefits also can help you reduce taxes. You just need to spend the energy and time, get it set up, and it is not late yet. And of course it will be late after 2023 for 2023 setup, but you can obviously set up that plan at any years. Also right now, there is a tax credit related to the money you're going to spend to set up these plans. So if you're interested in calculating and figuring out how much you can defer by opening those kind of account, then you can literally go to your financial advisor, have them do that for you, or you can come to community CPA and we can find you someone and we can calculate that for you. Now, our last slide is generally information of our firm. If you have any interesting topics that you want to hear, and you email Catherine@communitycpa.com. And our phone number is right there, 515-288-3188. We open 6 days a week, Monday to Saturday, and 8:30 to 5:30. And we have 3 branches with us. We have 3 staffed branch, and we have 1 other branch is remote branch. So you literally can reach us. Go onto our website, you will see a lot of us. And I hope to have you again on Tuesday. And I always do Tuesday 30 minutes, and the Saturday, about 45 minutes, an hour, kind of longer talk. And I am pretty proud of our firm can put together some string of knowledge, right? It's not just like one narrow focus of one thing. So when we talk about income deferral, saving taxes, we give you all the tools. Those tools, they don't come together because your tax people and your financial advisor people, they're just not same people. They don't talk. They don't put all of these together for you because they are separate bodies. But at Community CPA, we understand how knowledge are connected from A to Z. So we always talk to you about, if you look at income deferrals, what are all the tools? And if you look at a journey of a child, then at what stage, what way taxes is played out, like what? So those kind of things are all on our webinars, folks. You can go to check on our YouTube channel, and I will see you